getting the briefing underway, and just given the fact that yesterday obviously was a extremely quiet day for the obvious reason of US Independence Day and US market closures, not really a great deal to get you up to speed with in terms of market movement, so to speak, but there certainly are a couple of interesting articles and graphics that I want to show you this morning in the briefing, so we'll kind of follow that tact. One thing is cable though, just while I'm talking I'll be keeping an eye on. We've just broken below the fairly dull range that we were trading yesterday, and we've just gone through S1. Already a few murmurs in the chat. I saw Ollie mention that must mean then bad UK data coming up at 9:30. The reason why he's saying that, for any of those who are newer to the markets, is because quite often what you tend to see is a little bit of kind of market movement or positioning, which is often specifically for the UK quite telling to how the overall outcome of the data is. And so people tend to think that if you see some pre-market movement ahead of a big data release in the UK, then it's kind of a leak, or someone's putting around what they think the number could be. So maybe just worth keeping an eye on cable over the next hour. Obviously it's going to be around an hour when we'll see the data hit. But starting with the UK, obviously today is a very significant day. I've heard a lot of the news agencies like Bloomberg, you can see already on the TV, have been talking about it. But it was 10 years ago to the day that the Bank of England last hiked interest rates. I actually remember, I squawked it. I can remember doing the call when they hiked rates, probably showing my age a little bit here, because I imagine most of the interns were probably about 10 years old, which is quite frightening, a prospect. But looking at the interest rate chart, this is what we're talking about here. So if you put it into context, really this is where we were. We were seeing a regular kind of, I guess, going through the period of 2006, 2007, what would be a normal rate hiking cycle, kind of incremental increases of 25 basis points, or even steeper at 50 in some cases. And then obviously the financial crisis happened, a dramatic U-turn, one of the sharpest cuts to interest rates that we saw, taking it to unprecedented levels of zero interest rate policy, where we sat. We've obviously had the knee-jerk reaction. It would have been last summer, I think it was August if I remember rightly, when the Bank of England then, immediate aftermath of the EU referendum shock result, they cut interest rates again from 0.5 down to where we stand at the moment at a quarter basis point, or a 0.25%. And so, who can tell me then, two questions for you, you can see who's done their research, which are the only other two G20 nations to have not also have hiked interest rates in the last 10 years, like the Bank of England? Okay, good. You've been reading this morning. Japan. The other one, Saudi Arabia. They're the only two other countries with the Bank of England that haven't. If you remember, under Jean-Claude Trichet, who was the previous ECB president, he made a bit of a mishap when he mistimed an interest rate hike, only to take it back a few months thereafter during the recovery of the financial crisis. And then obviously ECB rates went even further to negative territory, as we know, in the deposit rate. One other question then. Let's see if Vas was pretty quick, or Philippe, on the back of that last question. What was the #1 single in the UK 10 years ago? Let's see if you can get that one. Wow, first answer, Spice Girls. I think you need to knock another 10 years, probably even further back. Wow, there are, if only you guys could see some of the answers coming in. Rihanna, Umbrella, was actually the UK #1 for a period of 10 weeks. That actually doesn't feel like that song's that old, but wow, there you go. But yeah, so interesting day then, because the reason why I talk about the Bank of England and the reason why this is quite significant at this particular juncture is because we've had in the last week predominantly last week, not so much so far this week, but a change in tact of central bank communication. And we talked about this a lot, about the Bank of England going from kind of a very dovish stance to now erring towards some manoeuvring of communication about potential changes to policy coming in the future. And this has prompted then expectations of a potential interest rate rise in the future. The timeline has shortened, i.e. we're getting closer towards potentially that point in time when we could see a rate rise. The main chief reason of this being that some on the Monetary Policy Committee believe that we should be focusing on the fact that inflation is rising rapidly due to the depreciation, of course, of the pound post-Brexit. And so with inflation at 2.9%, the highest it's been in a number of years, the 3 out of the 8, as it was in the last MPC decision, felt that now or June should have been the time when we should have hiked rates to get ahead of the inflation curve. The problem obviously being about the other side of this is the disparity about how unconfident the UK consumer is as household incomes have become more and more pressured by the fact that wages and inflation are diverging even further at the moment. So it's just interesting because one thing is we've had a bit of volatility in equity markets last week, and particularly to the downside, and a lot of people tend to talk about the potential for a market correction. I think one thing is when you're trying to gauge sentiment in the market, listening to what market pundits are saying. When I say pundits, I mean the guys at the banks, heads of desks, as well as journalists and economists, market kind of commentators that you get on Bloomberg TV, for example. And there seems to be a bit of a growing chorus that I'm hearing in regards to people, I wouldn't say calling the top, but are calling for potential for a bit of a pullback from these highly elevated levels. You know, obviously we've got, and we'll talk about this renewed now risk about geopolitical tension from the North Korean peninsula, and we've had troubled relationships with Russia and Syria and the US involvement. And then also the risk about Trump implementation, the fact that, you know, what has he realistically achieved, about how far we've and how strong we've risen over the last several months to where we've got to at this point. And so this leads me then on to, let me just switch over my graphics and I'll show you an article. If you just bear with me 1 second, I'll bring it up. There was a really good one I saw about how the VIX is seeing some changes and how people are pricing themselves at the moment. Okay, I've got it here. So what we're looking at here is you're looking at the white line, which is the VIX index, and then you're looking at the blue line, which is the VIX 3-month 25 delta calls versus puts. So what you're looking at here is we are, and we have been, in really record low volatility era. In terms of, although equity markets have risen to all-time highs, it's been fairly one-dimensional in its increase. But what you're starting to see now is, although volatility is still relatively low, you're starting to see people hedging for, in the future, impending volatility is on the horizon. This then makes sense if central banks are starting to become more hawkish for the first time, in the case of Bank of England, for 10 years. This obviously spells potential for a massive uptick in volatility on the back of being into a situation that we've not been in for a decade. The question is, how will markets and how will market psyche deal with a change of removal of such accommodative, loose monetary policy for such an extended period of time? So VIX options have essentially soared since the beginning of the year. Nearly 2.7 calls traded for each put. That's the most since 2007. And at around 4-to-1, the call to put ratio is at its highest since SEP of 2014. So what you're seeing then is people are starting to buy up protection for impending volatility in the future. So although we remain low, most or growing amount of market participants are fearing that this will not last going forward. You start, I guess, putting in other things like Fed balance sheet tightening, which again, this kind of fear of a taper tantrum type moment that we had several years ago, where the market, again, this removal of the stimulus is met negatively. You've then also got the Brexit negotiations, still the risk of Italian snap elections, Italian banking crisis. There's still plenty out there that could potentially be a trigger point. And so many people are kind of positioning for that. This is another interesting chart that kind of also shows a similar thing. And essentially what this is looking at is a S&P 500 VIX short-term futures ETN. And it's had inflows in June for a 5th month out of 6 this year. So essentially, if I just get the comment here to explain it, investors have reduced their bets against exchange-traded notes, sending the short interest to 23% of shares outstanding from 48% in March. So again, people, what this is telling you, these measurements, is that this period of calm that we've had in financial markets and this kind of one-dimensional move to persistent all-time record highs, particularly in the equity markets, which is the one asset which continues to sit and has not reversed some of the move that we've had since the US election, which is unlike commodities and unlike the dollar. You could say then that there's a potential growing for a market correction in the equity market ahead. Obviously, things like quarterly earnings season in the future would also be things that you'd want to be monitoring in the meantime. Okay, looking at some of the other news that we've had, a lot of it dominated by North Korea. North Korea raising the stakes in US missile standoff. In the new world of diplomacy, obviously we had Trump yesterday via the media platform of Twitter saying, you know, what is this guy doing? Well, Kim Jong-un firing back with ICBM, intercontinental ballistic missiles, a gift to American bastards on Independence Day holiday. That's an exact quote, not my phrase. That is from Kim Jong-un. And it's just quite frightening, really, what era that we're in, where tit for tat goes on this type of level. But in all seriousness, though, in other commentary, you've had the US Secretary of State Tillerson say new escalation of the threat last night, and that global action is required to stop a global threat. Obviously, we had Russia, Putin, and the Chinese president meet yesterday in Moscow. They both condemned the action of North Korea. And if I just have a look down here, you know, this is what people are getting growing concerned about. We did talk about this quite a lot yesterday. But this is about the range in which North Korea's missile capability is reaching. And the fact that you're talking about ICBMs is the distance in which they can cover. So now you're looking at the largest by land size state of United States of America. Alaska could potentially be hit by one of these missiles. And then obviously the very aggressive threat from North Korea that they could basically bolt on a nuclear warhead to one of these missiles. This is kind of the situation that we've got to at the moment. So this brings about the question then, how do you really deal with this going forward from a Western point of view? And the Sky News had just a good, I guess, a 5-point summary of the various different options that could be followed going forward. Option 1 is China, and this is really the one that we're seeing. This is predominantly the US, and what you'll find when we have these kind of global level geopolitical events, it's typically the US that's the flag bearer for the kind of Western world, so to speak. And we looked at this yesterday at the defense and military spending of various countries. And what you can quite clearly see is the underlying reasons then why the America is the biggest economy in the world, why they have such a presence, why they're the global trade partner. When you're talking about a country that every year puts in defense and military spending about $600 billion. In comparison, second place is China, and they only do about $200 billion. Britain, for example, I think is around $70 billion. Again, the US are doing 600. So the second largest, they're doing 3 times more investment. You know, if you were going back in history of how, I guess, human history has worked in terms of the power and dominance of nations, he who has the biggest army wins. The problem is China, obviously, with more affluence in their general society as a whole, and the growth rate of their country comparative to the slowness in Western Europe and in the Western world, they are closing that gap, and then hence you're getting this kind of power struggle at this point in time. But China is absolutely critical to a deal being done, and that's because of China. We discussed yesterday their relationship with North Korea. So option 1 really is Trump trying to push China to influence their neighbor. When you think about it, really, given that they have a geographic border with the country, they can do things like, most extreme would be to cut off their food supply. At the moment, you talk about financial sanctioning. If you cut a nation's food off, that's a whole nother level of escalation. Would China do that at the risk of a nuclearized North Korea? I highly doubt it. But certainly this is what Trump has been angling for at the moment. And given the G20 commences on Friday and carries on into the weekend, this is going to be a really key point. I would imagine all else is kind of off the table. Really, North Korea will probably be one of the main talking points from the weekend. The other option is, as we just said, sanctions. The UN has already imposed several rounds of sanctions on Pyongyang, but China is regarded as being able to deliver the most economic stinging kind of blow. So sanctions is another route. Option 3, military strike. Trump has insisted that a military strike is possible. In fact, overnight, what has been the US and South Korean response to the missile tests from North Korea yesterday? They've just conducted military drills in the Korean Peninsula themselves. Again, this is quite a frightening game of blinksmanship here. You've got US naval ships and ballistically armed missile-carrying submarines sitting on the Korean Peninsula, and in a response, they've also flexed their muscles overnight. And so I don't really see military engagement ever really happening because of just the huge fallout that would have globally, and it's not in the interest of any of the major power players here, i.e. that being really the USA, China and Japan. And so a military strike, I think, is probably the lowest, but will they carry out military drills? Then sure, they definitely would. And actually, talking about 10 years ago from the Bank of England, it was actually 10 years ago, pretty much to the month, North Korea fired missiles into the Sea of Japan. And so 10 years on, you know, are things much different? Yes, Kim Jong-un has upped the frequency of testing, and certainly it's to be monitored, but you know, we have been here before, and it hasn't gone to the point of military action. Option 4, you've got diplomacy. This has been tried before, as you can see. George W. and Clinton have tried this but failed really when they've gone about this. But the G20 is happening, so let's see how this sits when we get back into the markets on Monday morning. Option 5, you learn to live with a nuclearized North Korea. That is that just inevitable in the end? You know, you talk about someone like the USA. I can only imagine how many nuclear weapons USA has in proportion to every other country on the planet. I'm sure it's exponentially higher than everyone else. And so is this just a case of you have a nuclear capability in North Korea, as you do in Russia, as you do with Trident in the UK, as you do with Europe and the US, and this is just the state of play going forward? Obviously it's not a particularly warming situation to live in, but is this just now the new modern reality? So 5 options, just quite interesting to cover. Okay, just going through some of the other news stories then. to have a look at. This was a headline that's come out from overnight, I should say. This was Bank of Japan to cut inflation forecasts and hold off easing. This is according to a Reuters source. So the Japan Central Bank will cut its inflation forecast but hold off expanding stimulus this month, according to people familiar with the matter. Another sign that the bank is retreating from Kuroda's initial pledge to do whatever it takes to achieve his ambitious inflation target. I wouldn't say this has had too much of an underlying impact. If you look at the actual yen, I guess we've seen a little bit of weakness, so dollar yen is moving higher. We've just moved above the high print from yesterday's session here into slight positive territory in dollar yen. Inflation forecast then being cut would probably might explain the reason for that. If you look at inflation though in Japan, it really has been stuck in the mud. If you look at other countries, we've had a push back towards target, certainly in regards to Europe and the ECB and the Fed, albeit we've started to just move away from it slightly. Bank of England, obviously, we're almost 1% above target. But in Japan, they also have this 2% threshold, which they try to govern policy toward. But you can see, really, we've just sat there at around near zero levels. And in fact, if you start putting Japanese inflation on a longer time frame, really inflation has been going nowhere for a very long period of time. We're going all the way back into really 2015. And so despite this kind of low interest rate environment, improvement in the economic performance in Japan, albeit slowly, it hasn't yet cultivated inflation in the country. And so the Bank of Japan expected, according to these sources, to be looking to cut their forecast going forward. Elsewhere, quick look in the energy markets. Obviously, this is the communication strategy I'm sure you guys are more than accustomed to. If we look at the price of WTI crude, obviously we've had a phenomenal rally really from the initial low point that we had printed close towards the $42 handle. We have now risen approximately 12.5% since that big decline that we had immediately after the OPEC meeting at the 25th of May. And so now there's really a lesser need for OPEC officials, non-OPEC like Russia, to really comment too much. And no surprise then to see, although Russia have commented, citing 4 Russian government officials, they basically want to stick to the current OPEC deal, and they would oppose any proposal for deepening production cuts at the group's ministerial meeting later this month. So what they do now is that the next official OPEC meeting is not for several months, but they have kind of technical meetings to make sure that countries are adhering to their predefined quotas as per the agreement, to make sure that compliance is being adhered to. But Russia basically saying there's no need for a deeper cut at this point, which makes sense. The price has already recovered to definitely a level of which most will be much more happy with now that we're a good $5 off that initial low point. Okay, so looking at the calendar for today, one thing is obviously Independence Day holiday is now passed, so we'll be looking for kind of normal service to resume, so to speak, in terms of volume and market movement. Looking at the calendar for this morning, as we come up towards 9:30, there is an important piece of economic data. We talked about this briefly yesterday. This is UK service PMI. It's important given its large contribution to gross domestic product for the country. And so what you need to do with the PMIs, I guess, is look at the suite of PMI releases that you get on a typical week. And there's 3 readings. First up, on the Monday, you get manufacturing PMI. And this you generally used, I guess, although it's a different sector, just to formulate a good overview of the general key contributors, if you like, to growth in our country. So manufacturing. It is in expansionary territory. How these PMIs work is 50 is the marker between expansion and contraction in terms of this sector. And so it is growing. The only problem is here we're starting to see a pretty persistent or consistent pattern of decreasing from the initial high that we printed in April. And so again, this fits into most market expectation that going forward over the coming months, as Brexit talks continue and inflation remains high with a lack of improvement in wages, that generally speaking the UK economy will continue to slow, and so will net growth then in the UK. So manufacturing PMI this week on Monday was the weakest pace of expansion in the manufacturing sector since March. It came in at 54.3, which was below the expected 56.5. So we were expecting a reading up here. Instead it came in down here. So it was quite a bit softer than expected. Yesterday you had the construction PMI, 54.8, slightly below the expected 55. But still fairly high, I guess, on the readings, but at a move lower from the prior month. So going to services, what you've had here is you've already had a decrease from April to May. The question mark is, where does it go from here? The last reading came in at 53.8. That was below the expectation of 55. So again, it was quite a big miss last month. If we just flick back to the calendar, let's see if they've got an expectation. The expectation is for 53.5. So a fairly similar print, but keep in mind we've had a very big miss in manufacturing, we've had a weaker construction number, and looking at the market this morning, cable is trading a touch softer as well. Whether this is any sort of telltale sign, yet to be seen, but what I would be doing is over the course of the next half an hour going into that release, just keep an eye on the sterling price action. Also, if you start looking at, I guess, cable on a slightly longer dated chart, you need to put it into a bit of perspective of where we've been in the last week or so to where we are now. Obviously we had a really strong rise, so post the gap lower and a couple of tests at a key level on the downside after the hung parliament from the UK election, the Bank of England had then turned hawkish amid these inflationary conditions, and as probabilities of an interest rate hike in the UK have increased, so too then has the value of the pound. So we've got a bit of support around this S1 at the moment, but going below there, if we get a weak print, certainly a move down to test S2 cannot be ruled out. That's 129.04. That obviously closely aligns with the 129 psychological, just a handle. Then you've also got 128.97, which was that initial blip high when Carney was speaking. And so pretty decent levels here. Obviously, if they were to break, then probably opens up even a further extension down towards then some of the levels that define the top of the range immediately after the hung parliament. Again, you'd need a pretty big miss, I would say, in order to pull this down. But if it does come out weaker than expected, this in a monetary policy sense means that really the argument to hike becomes less compelling, because the UK economy would be anticipating then to slow more rapidly than many might have thought. So cable's going to be definitely one to watch later, and we'll be covering that in full obviously when we get closer to the release. Okay, quick look at the calendar then, just to round things off for what we've got for the rest of the session. Again, other than that, things are fairly quiet. You've had the various service and composite PMIs out of Europe, but these are final readings, hence there's not really been too much price action. You've had a little bit of a flurry while I've been speaking in the DAX, but again, nothing really that you could pin on data, I would say. Just looking here, you had in the futures that R1, that pretty much matched up to the T with the resistance level from yesterday afternoon. That was also close to around, you can see here pretty much a triple kind of top that's formed over the last few sessions. That probably just saw some stops triggered, hence the extension on that wick and the pullback here on that price action, because fundamentally there's not really a great deal of news out there. And what might happen is really we need North America to come back in the market, and then we'll start to see the order flow pick up and a little bit more defined kind of price movement. But cable certainly will be one which no doubt will move in about half an hour's time. In the US session, nothing really too much of interest. The mortgage applications, chain store sales, red book, these are all insignificant. These would all be classified as much lower tiered data that doesn't have any impact on US assets. The durable goods is an important report, but this is, though, the revisions to durable goods, so it's not the actual report, and it's backdated now to April revisions, so unlikely to be of too much interest. The main data really is the factory orders, the IBD tips coming in at 3 o'clock, and then you've got the FOMC minutes as well to follow at 7 p.m. this evening. Due to the Independence Day holiday, API crude oil inventories, so as per the usual process, have been delayed by a day, so they'll be due this evening, with the Department of Energy's crude oil inventory report to be released tomorrow afternoon at the slightly later time of 4 p.m. Okay guys, going to leave it at that, let you get on with the session. So UK data coming up, heads down for that one. It will be a market mover, I'm sure. So good luck for the day, and I'll see you in the chat room. Thank you very much.